Welcome, my name is Leanne Borgen from Henderson Brothers Financial Partners. The seminar you are about to watch is all about making investing feel simple and approachable. We'll break down the basics of investing in your retirement plan and walk through a few key considerations to help you make informed decisions moving forward. During the session, we'll talk about the items you see here. We'll do an introduction to Henderson Brothers Financial Partners. We'll talk about why investing matters. We'll look at market timing versus long-term investing, asset classes and diversification, and resources and planning tools. Before we dive in, I want to give you a quick snapshot of who we are. Founded in 1893, Henderson Brothers has spent more than 130 years helping businesses, individuals, and families protect what matters most and plan confidently for the future. We provide a wide range of services, but today's discussion ties most closely to Henderson Brothers Financial Partners, our independent financial planning and retirement consulting team, which is the team I'm part of. As the financial advisor to your retirement plan, our team goes beyond helping oversee the plan itself. We're here to support participants like you with retirement readiness, financial wellness, and guidance that helps you make informed decisions throughout your financial journey. A little later, I'll walk through how we support you not just with your retirement plan, but with your overall financial wellness too. Let's take a minute to discuss why investing matters in a retirement plan. You might hear the phrase long-term growth, but what that really means can look different for everyone, depending on where you are today and what your goals are. What we do know is that there are a few key principles that can make a big difference over time. Things like contributing consistently, taking advantage of compounding, and staying invested through different market conditions. We'll walk through each of these so you can better understand how they work and how they apply to your own situation. Beginning early provides decades of compounding potential. Regular contributions made over a longer timeline allow investment growth to build on itself, often resulting in a significantly higher retirement balance. This is a great example of how starting early can make a meaningful difference. On the left, you'll see Investor A, who begins contributing earlier but for a shorter period of time. On the right, Investor B starts later but contributes for longer and even invests more overall. Even though Investor B puts in more money, Investor A still ends up with a higher balance over time. That difference really comes down to time, giving those contributions more opportunity to grow and build on themselves through compounding. The key takeaway here isn't about trying to invest large amounts, it's about starting when you can and staying consistent along the way. Now let's take a closer look at what's actually happening behind the scenes. This is the power of compounding. Compounding is simply when your earnings start to generate their own earnings. So it's not just your original contribution growing, it's the growth on top of that growth over time. In this example, if you invested $1,000 and earned a steady return, you could end up with about $3,700 if you were only earning interest on the original amount. But when those earnings are reinvested and continue to grow, that same $1,000 grows to over $13,000. And you can see on the chart that the growth really starts to pick up later. That's compounding at work. The key takeaway here is that time plays a big role. The longer your money is invested, the more opportunity it has to grow on itself. Another key concept that can support your investing strategy is something called dollar cost averaging. This simply means investing a set amount of money on a regular basis, like each paycheck, regardless of what the market is doing at the time. When markets are higher, that same amount buys fewer shares. When markets are lower, it buys more shares. Over time, this can help smooth out the impact of market ups and downs and take some of the pressure off trying to time the market. And as you can see here, market declines are actually a normal part of investing. They happen from time to time, but those periods can also create opportunities to buy at lower prices and participate in future recoveries. The key takeaway here is consistency, continuing to invest regularly even when the market feels uncertain. Now that you understand why it's important to invest and stay consistent, let me ask you this question. How many of you have ever felt the urge to make changes when the market gets volatile? Markets will always have ups and downs. That's completely normal. When that happens, it can be tempting to try to time the market, but that's very difficult to do consistently. Instead, focusing on a disciplined approach, investing regularly, and staying diversified can help you manage those ups and downs over time. The goal is to stay focused on your strategy and not let short-term emotions drive your decisions. So we just talked about how difficult it can be to time the market and why reacting to short-term changes can be a challenge. Let's take that one step further and look at what can happen when you miss some of the market's strongest days. Missing just a few top-performing days can drastically reduce long-term returns. When we think about reacting to market ups and downs, one of the biggest risks is missing just a handful of the market's best days. And what's interesting is those strong market days often happen very close to the worst days, during periods of high volatility when it can feel most uncomfortable to stay invested. Looking at this example, you can see that a $10,000 investment grows significantly over time, but missing just a few of the best days in the market can make a meaningful difference in the outcome. The key takeaway here is that it's not about getting in and out at the perfect time. It's about being disciplined by staying invested and giving yourself the opportunity to capture those periods of growth when they happen. It's also worth noting that discussing large allocation changes with an advisor could help an investor avoid emotion-driven financial decisions. We've talked about the importance of staying invested and taking a disciplined approach, and diversification is a big part of how you do that. Diversification simply means spreading your money across different types of investments, rather than putting everything in one place. Here you'll see a few common asset classes you will have to choose from in your retirement plan. At a high level, investments like stocks, both US and international, tend to offer higher growth potential, but they also come with more ups and downs along the way. On the other end, investments like bonds and cash tend to be more stable, but they typically offer lower return potential over time. And then you have a balanced option, which combines different types of investments into one mix. The idea behind diversification isn't to avoid all risk. It's to manage it by not relying on any one investment to do all the work. That way, different pieces of your portfolio can perform differently at different times, helping you to smooth out your overall experience. If you were trying to pick the top performing investment each year, how confident would you feel? It's not as easy as it sounds. This chart shows how different asset classes perform each year, and you can see that leadership changes constantly from year to year. There's no single investment that performs best every year. That's why diversification is important. Instead of trying to pick the top performing investments, you choose investments across different asset classes. The yellow boxes show a more diversified approach, less extreme ups and downs, but still steady growth over time. It's about consistency and staying invested, not trying to predict what's coming next. So now that we've talked about diversification, the next question becomes, what does the right mix look like for you? The answer is it depends. Two of the biggest factors to consider are your time horizon, how long you have until retirement, and your comfort level with risk. If you're earlier in your career and you have a longer time frame, you may be able to take on more growth-oriented investments, even though they may come with more ups and downs along the way. As you get closer to retirement, or if you prefer a more stable experience, your mix may shift to include more conservative investments that focus on preserving what you've built. There's no perfect allocation, but the goal is to find balance that helps you stay comfortable and stay invested over time. So now that we've talked about finding the right mix, the next step is understanding how you actually put that into action with your retirement plan. There are generally two main approaches you can take. The first is using a pre-built portfolio. These are designed to do the work for you and they're already diversified. The second is building your own portfolio where you select and manage your individual investments based on your preferences. There's no right or wrong choice here. It really depends on how involved you want to be and what you feel most comfortable with. On the next couple of slides, we'll take a closer look at each of these approaches so you can better understand how they work and decide what might be the best fit for you. Let's start with pre-built portfolios, also known as target date funds. These are designed to simplify investing. You choose one fund based on your expected retirement year and it's already diversified for you. Over time, the fund will automatically adjust to become more conservative as you get closer to retirement. It's a more hands-off approach, ideal for those who prefer a set-and-go strategy. The second approach is building your own portfolio. This means you're selecting the individual investments within your plan and deciding how much to allocate to each one. You're also responsible for monitoring your portfolio over time and making adjustments as needed. This approach gives you more control, but it also requires more time, knowledge, and ongoing involvement. It tends to be a good fit for individuals who feel comfortable making investment decisions and prefer a more hands-on approach. As we look at the big picture, here are a few key concepts to take away from this meeting. Successful retirement investing isn't about being perfect. It's really about staying consistent with your approach over time. We know that markets will go up and down. That's a normal part of investing, but reacting to those short-term changes can sometimes do more harm than good. And finally, it's important to make sure your investment strategy aligns with your personal situation, your goals, your time frame, and your comfort level with risk. You already have access to tools and resources through your retirement plan provider that can really help support everything we talked about today. One of the simplest steps you can take is just logging into your account. From there, you can review your balances and contributions to make sure you're on track. You can also update things like your contribution rate, your beneficiaries, or personal information. Many providers also offer planning tools that let you see how today's decisions can impact your future. Things like retirement projections or different saving scenarios. That can really help connect today's budget decisions with your long-term goals. Before we wrap up, I want to show you one resource that really brings everything together. This is a tool we've made available to you called Venrollment. What I love about this resource is how easy it is to use. There's no login required. You can simply scan the QR code on the screen and it will take you right to your personalized site. This page is built specifically for your plan, so everything is tailored to you. It's really meant to be a one-stop place where you can go for information, support, and next steps. Right at the top, you'll see a short video walking through your plan highlights, so if you ever want a quick refresher, it's right there. You can also schedule a one-on-one meeting directly from this page, whether you want to talk through your budget, your retirement plan, or just ask questions. You'll also find important contact information, plan documents, and links to your provider all in one place. So instead of trying to track everything down, it's all easily accessible. Another great piece is a library of short videos on financial wellness and retirement topics. So if something we talked about today sparked your interest, this is a great place to keep learning at your own pace. And this really reflects the support that's available to you. This isn't something you have to figure out on your own. If you take one step after today, I'd encourage you to scan the code and just take a look around. As we wrap up, I want to leave you with one final thought. Financial planning isn't a one-size-fits-all. Where you are in your financial journey matters, and everyone listening to this presentation is likely at a different stage. This slide highlights a few common life stages, from just starting out to mid-career to nearing retirement and into retirement. You might fit neatly into one category, or maybe you're in a mix of these categories. No matter where you are on this journey, this is where we come in. At Henderson Brothers Financial Partners, we're here to help support you at every stage. Whether you're just getting started or already thinking about retirement income. That could be answering a quick question, helping you think through a decision, or sitting down one-on-one to build a plan. You don't have to have everything figured out before reaching out. That's what we're here for. So if you ever find yourself asking those types of questions, I want you to know you have access to support. And that brings us to how you can get in touch with me. You can reach out directly or schedule time to connect one-on-one, whatever works best for you. Whether it's a quick question or a more in-depth conversation, I'm always happy to help. My goal is to make this feel approachable and manageable no matter where you're starting from. And that brings us to the end of the Investing Made Simple seminar. Thank you so much for your time today. I hope you're walking away with a better understanding of how investing works and a few simple steps you can take to get started or stay on track.